This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The Fed's flying blind, and it's conflicted by strong growth as well as an existential threat to its employment goals. This week, they threw a curveball and struck out the forecasts, and we're left with two starkly different scenarios for what comes next. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and we are in the thick of earnings season. And ultimately, those results are what is moving the market. But we also had a Fed meeting this week, and yeah, they cut rates by another 25 basis points. But the big news of the week was the statement, quote, "A cut in December is not a foregone conclusion." And that statement there by Jerome Powell on Wednesday led to a bit of a sell-off, and I was a bit surprised at the enormity of the reaction to this statement. I mean, did anyone really expect him to say something like, oh, yeah, we're locked in and we're going to cut again in December? Or did they expect him to say anything along those lines? Well, I look back at the JP Morgan report, their FOMC preview report, and yeah, while they expected, along with everyone else, that the Fed was going to cut by 25 beeps this week, they also said that they thought, when asked, Powell would reference the Fed data from September and imply that a December cut was likely, if not entirely, insured. So they expect, JP Morgan expects, another 2 cuts coming in the spring of 2026, while they also anticipate stronger economic growth than the Fed was indicating that they see right now. So what was lost a bit this week was the Goldilocks scenario. We lost where there was such conviction in an accelerating economy at the same time that the Fed was cutting interest rates. And that scenario seems counterintuitive, since the Fed wouldn't need to cut normally in the face of a strong economy. But if it does remain strong, as it has with soft jobs growth, then they could lower rates as long as the inflation problem was tackled. But that remains to be seen. Instead, they've now set the stage whereby they're getting back towards the neutral rate, and they're going to probably wait and see to see which side of that mandate they have requires more attention, even if the downside risks to employment have now risen. So it's not the end of the world, but it's requiring a lot of models like the ones that JP Morgan has to be tweaked now, to reel in a couple of those assumed upcoming rate cuts, which could leave some maybe upside surprises in the near future if everyone now reels in their expectations, and in the end, maybe we actually do get those cuts. Maybe we'll see a big rally in December. In fact, when I flipped on the news pretty early Thursday morning, on the heels of the results from some of the biggest tech names in the market, which were moving them respectively up and down quite a bit based upon their respective results. But I also heard that overnight there was this, we'll say a kind of a breakthrough in Asia, that tariffs are going to remain modest, that the 100% tariffs against Chinese goods were now off the table, that they're going to buy our soybeans, and we're going to keep getting deliveries of these rare earth materials for the next year. Well, when I heard that, I thought the markets were going to rejoice that I would hear that futures were way up. But juxtaposing the negative reactions in the markets when the trade war had recently escalated with big threats in the headlines. But the markets didn't invert those sell-offs we saw when the 100% tariff was proposed. The markets didn't focus on international trade. Instead, we're still seemingly focused on the Fed's cautionary stance, although at the time of this recording, both the fiscal policy news and the trade war seem to be falling aside a bit, at least for the moment, and instead earnings results are more front and center again. As at the moment, it's now kind of flattening out. But the Dow was up a good bit, and the more tech-heavy S&P 500 was negative, although the market breadth, the kind of balance of up to down in that benchmark, was mixed. There were actually 3 gainers on the day when I walked into the studio, compared with every stock that was down for the day. Notably, also in the Fed's announcement and in Powell's press conference, is that they were done for now winding down their balance sheet. The Fed is no longer allowing bonds to mature. They had gotten to a place where their asset holdings were basically in line with the reserves that he said they felt were appropriate, meaning that while they're trying to juice the economy by buying net new treasuries and mortgage bonds, they're no longer going to continue to let them expire without replacing them, letting their assets wind down as they've been doing over recent times. What this means is that longer-term interest rates should have less upward pressure on them from the Fed's actions. That all things being equal, the Fed may show now a bit more support to lowering borrowing costs, especially for mortgages, and that'll give a little bit of help to the housing market right now. Also standing out from the Fed's position now is that Powell said that we are now in sight of the neutral rate. We might be pretty close to it. And that's not a rate that's empirically known by economic standards. Various Fed governors give guesstimates as to where they think the neutral rate is. But it's the rate at which the central bank, if they were right on it, they would be neutral. They're not fighting inflation by having rates higher than that rate. They're not supporting economic and job growth by having the Fed rates below that neutral rate. They see now, in the face of some missing data due to this government shutdown, that their current stance is more or less straddling that line, and that they need to instead see some greater threat to the full employment level than inflation to really keep cutting rates much more, although we did say something along the lines of building in some room for error, a little bit of a cushion. And that's why the market backed off a bit of their enthusiasm for further support through more rate cuts in the near future. Powell did acknowledge that, quote, the downside risks to employment have risen, end quote. And with a panel of voting governors that's more divided than usual, Powell definitely doesn't have the rubber stamp that he maybe once had for the outcome on the December meeting's decision. And another cut is still more likely than not. But it would help if the government did get going again and they could have a more fuller view of the data that they normally depend on for these decisions, instead of this greater reliance on, we'll say, third-party sources. Like they said, he was looking at data from Indeed, these employment brokerage businesses. Another takeaway for me, and something that I've mentioned before here, is that Powell pointed out that conquering the threat of higher inflation isn't ultimately resolved by seeing the prices that we face day to day, going back to what maybe you think things should cost, back to where they were 5 years ago. But rather, what it means to really conquer inflation is that wages, the rate of wage growth, rising faster than inflation for a sustained period, essentially prices stabilizing, but wages going up more than that, so that, yes, you are paying these higher levels for the same goods, but the average consumer is just that much more able to pay for these prices and having their larger paychecks going that much further for them, hopefully even saving a bit. Now, don't expect the price that, let's say, an imported sneaker that you got to get cheaper. But know that on average, the typical American now is earning more than they were earning 2 years ago, inflation adjusted. And while they might not like it when they see these price tags, actually, empirically, the average consumer are able to handle it better than they were a few years ago. And, sneakers are actually a pretty good example. It's not a quintessential good in economic theory because, they're not costing $500 a day compared to what normal inflation rates would have pushed them at versus what they cost 5 or 10 years ago. But they're really similar in price to where they were a decade or more ago. And, in a sense, a pair of Jordans cost less today than they did 20 years ago, inflation adjusted. And that's largely because they can be manufactured for less. The company can maintain higher margins if we're going to have efficient economic trade, allowing that good to be manufactured for less. And ultimately, the main cost is in marketing for those, which basically all brings us back to tariffs. We, collectively, learned a lesson in April, and it was taught again recently when Trump threatened 100% tariffs on all Chinese goods. Learned that we shouldn't be overplaying the effect of what's threatened in the headlines and what the market's reaction is to them, but we should wait and see what is actually imposed. And we'll have to see how the latest kerfuffle with Canada sorts itself out. But the base rate now on all American imports is a tariff of 10%, which according to strategists is well below the consensus estimate of 18%, or about 0.5% less of an impact on GDP than the FactSet consensus forecast. Nonetheless, a 10% import rate or a tariff rate on all imports, while having some real discernible negative impact on the consumer, it ends up being a backdoor way of increasing tax revenue. You're getting more from Americans to pay into the Treasury. And when paired with a rising wage basis and a growing economy, it may reflect a way of getting closer to some sort of fiscal balance without that political headline risk of someone saying we're actually going to raise taxes on the workforce. However, while most of the analysis I've read said that Trump's agreement with China lacks details, although it did include what I've already mentioned, the strategist analysis was that it maintains the status quo, and they expect the two nations to continue what they call a managed decoupling. And they expect this to result in an ongoing annual renewal of this status quo. So hopefully we don't have to go through this roller coaster every 12 months. But it gives us some time, each of us, China and the U.S., to basically reconfigure what they want here, which is to decouple and to reconfigure that their various mutual dependencies, leading to ultimately a time when we got real problems to sort out, when we're no longer absolutely codependent as we are now. And then, whenever that may come, we are going to have to function more truly as the adversaries which we actually are, which is why in the end, we still aren't going to allow China to have our most advanced technologies, especially those chips. And without knowing, I would assume a sticking point on the other side of the table is that China is pushing back when we put forth efforts to get them to stop playing ball with Russia, because that's their long-term partner in this decoupling effort. All right, I'm going to run into a quick break right now, but I've got some more for you today, so stick with me. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back in a moment.
The unwieldy fire hose of daily news flow is only getting stronger. How do investors separate the noise from what actually matters? Tune in every week as we discuss the latest financial trends and how to filter what's distracting you from investing success. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. The more I dive into the combination of all these various sources and all these issues as they intertwine, the more I get concerned, not necessarily about what the market's going to do tomorrow, next 3 months, next year, who knows, but the longer game of, let's say, 3 to 5 years of how this actually may work out. You know, I've been emphasizing since the end of last year that we'd have to look at the health of the consumer and how it's able to carry this economy. And I guess that's largely been wrong, at least as far as the markets are concerned, since this year the markets have been all about the trillions of dollars that are flowing into building out this AI economy, and that's what's mattered most, although the consumer has been doing a decent job this year. And while it's not my point today, but I have been thinking about this, and again this week, I had recently talked on the show about how AI is going to produce, or how it might produce, ultimately a return on investment. Not what you might be investing in, not you buying the companies, but how these companies are going to get a return on the trillions of dollars that they're investing into the AI infrastructure, to see a return there. It's going to basically require a combination of either an increase in productivity or a cannibalization of jobs, and the combination of those two to a sufficient degree as to create a return for the companies that are building out these capabilities. But what I'm really thinking about recently is how many of these companies, and also the nations behind them, are investing in AI in somewhat the same way in which we were investing in nuclear weapons in the 70s and 80s, as the fear is more about falling behind rather than focusing on an intelligent allocation of capital. And I'm no naysayer of AI. We actually use it for certain applications at work that fulfills that productivity and savings goal that I was talking about. And I have no doubt that a ton of capital is still in the pipeline that's going to keep building these networks and the models. So that juggernaut is still apparently going to keep going for the foreseeable future. But the thought is that the companies themselves aren't operating. They aren't necessarily judging the dollars they're spending in terms of what that return may be, not in the same way a company would consider normal expansion projects or investment in infrastructure or goods or factories or what have you. But instead, they're operating from the fear of falling behind, maybe more so for the countries, the U.S. The U.S. doesn't want to see a world where they've fallen behind China in their AI models and computing capabilities, and big tech firms don't want to have to catch up and pay and buy the access from those who succeeded more. The big guys need to stay ahead of that curve as they're driven by the fear that the others may develop a model that makes their own existing business, their own cloud platforms, their own search engines, their social media, their advertising. They're worried that it becomes obsolete compared to what someone else may develop next with their AI model. So they're left no choice today but to keep proliferating and keep up with the pack without knowing if they'll profit from the efforts. But in the meanwhile, those selling the goods to build these models are going to keep raking in the dollars. On the other hand, we are still left with the American consumer, who's been whipsawed a bit this year, but generally still stand strong, but are seeing some problems and facing some real challenges ahead. We are missing some data on the economy currently, but for what it's worth, we got the October consumer confidence reading just this past week, and it showed a pretty healthy reading of 94.6, and that was ahead of the consensus estimate on FactSet, which was 94.2. It was a bit lower than the previous month. September's was 95.6, but it's nothing too alarming or really very encouraging right there. We also saw all industry PMI reading, and that's a very solid leading indicator of the economy, and it came out at 54.8, squarely in growth territory. And according to JP Morgan's report on it, it was at the higher end of the range over the last 3 years, and it is, quote, pushing back our expectation, that's JP Morgan there, our expectation for fourth quarter growth to slow, end quote. And then there's employment. Goldman Sachs discussed in a report this week, and in there they said that GDP growth estimates have moved up sharply, putting them on the same page as the folks over at JP Morgan. But they point out that while some data here is frozen while the government remains closed, the GDP growth rate is tracking over 3%, but it's distorted by inventory front-loading and some trade issues this year, while other surveys like PMI are tracking more towards a neutral rate. And that's making a bit, according to Goldman Sachs, argument for a stagflation scenario, not dissimilar for what Jerome Powell was cautioning about this week when he was backing down expectations for further rate cuts. But more troubling, though, and this gets back to the health of the consumer, is that Goldman went on to point out that the employment trends are worsening. And in fact, they say that, quote, the expected change in the unemployment rate over the next year has never been this bad outside of recessionary periods since the University of Michigan started asking the question in 1978, end quote. And they go on to say, quote, U.S. jobs growth has slowed sharply this year, with the underlying trend falling from about 150,000 jobs a month at the start of the year to 25,000 jobs a month by August, below our estimate for the break-even rate needed to stabilize the unemployment rate, end quote. Which all ties back into the question if things are worse than they may seem. And, we're not seeing big spikes now in unemployment. We're not able to see anything right now because of the government closure. But during the year, as we've seen the labor force reduced from changes in immigration and lower labor force participation, some of this doesn't show up immediately in the data, since while there's a lack of job creation, there's also not yet this level of unemployment claims you might expect. The U.S. now, and I think this is somewhat relevant and not a huge focus, but the U.S. has 10,000 baby boomers turning 65 every day right now, or approximately 4 million people a year. And there are a lot of people exiting the workforce, and we're seeing less growth of the workforce from immigration. So we're holding steady on the data, but Goldman is projecting that may change in the next year. And to tie this back to the introduction of AI into the economy, there was an article in the Wall Street Journal this week titled, "Tens of thousands of white-collar jobs are disappearing as AI starts to bite." And the article cites some of the major job cuts that we've seen over the last few weeks from very big American companies, numbers which aren't in the non-existing data yet. But the article goes on to point out how much longer it's taking job seekers, especially those that are just entering the workforce, those just graduating college, to now find a job offer. And the article has a lot of stunning anecdotal evidence. But what really struck me most, and why I brought it up here, is a real example of what I've been saying, is one quote where a CEO said that he has cut 80% of his software development team, while at the same time, the company's productivity and ultimate results have surged. So for now, and I'll wrap up this week by saying these are troubling times for a lot of workers, and especially for those of you who have kids coming out of college, but I don't think it's showing up yet in the forecast for investments. I don't think this is necessarily a screaming red flag for the stock market yet. Many of the companies are using this period to get leaner. They're seeing higher margins as a result of it, and ultimately earnings are growing at a faster pace than expected. As an investor, what this means is we need to be on alert for where these cracks are developing. It's going to affect different industries differently, and ultimately could have a bigger effect on the markets. But let's not lose sight on some of the attractive runway that's also still out there for so many of the businesses and the capital that's flowing in the face of an environment that's making cash cheaper. All right, that's it for me this week. As always, thanks for tuning into the show. For the Wise Investor Show podcast, I'm Chase Hinderstein. Have a happy Halloween.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.